and welcome to a brand new episode of Smart Money, your favorite weekend show. Now, this week we have the much awaited show where we talk about what are the themes that you should invest into, what are the stocks that you should look at as the Nifty hit that 18,000 mark this week. And I have with me right here in the studio Gurmeet Chadha, Managing Partner and Chief Investment Officer at Complete Circle Consultants. Gurmeet, thank you so much for being with us here. You know, the equity cult is back in a big way, right? You can see it on the screen, you can see it when you go out. Tell us, how does one approach it?
So, Sonia, I think it's good to be on a day when markets fall and discuss, themes and ideas. So we broadly think that, three things on the balance sheet, which we say individual balance sheet, Indians are buying more houses and cars. Corporate balance sheet, they are spending, doing capex. Government balance sheet, they are spending. So the confidence around all three balance sheets are high, which augurs well for a few things if you club around them. So I think mobility, home improvement, manufacturing, because India is now recognized and expanding the footprint there, defense, and why we are here Friday evening discussing financialization of savings. So these are the five themes. I think if you bucket it well, there are some interesting long-term ideas there.
Okay, I know that viewers are, waiting very keenly to talk about the stocks, but I also want to discuss that big theme, right, which is that corporate profitability to GDP ratio is now at a decadal high of 4.3%. We haven't seen this in a while. Do you think it can only get better from here? And before we start talking about the big themes, what's your view on how much the market could capitalize on that?
So you're right. I think the profitability, not only is the profitability better, the health of the balance sheet is better. Look at the deleveraging which has happened in a lot of names, commodity names, energy names, courtesy the cycle we've got. Look at the bank credit growth. I've not seen 15% credit growth for a long, long time, right? And when was the last time you saw Nasdaq down 5% and Indian markets showing a lot of resilience few days back, right? So I think it will reflect, I think the Nifty earnings estimate, if you are still able to, a softer growth of 7 versus 8 and nominal at 12, I think Nifty EPS should still be 1,000, which means on a valuation, you're still at 17, 18 times, while we are premium, right? But if you see a 10-year average, it's still 17, 18 times. So we are in the fair zone. We are not in the... So as, if there are earning upgrades and as commodity falls, probably some consumer user companies will come into picture. My sense is there could be selectively some earnings upgrade coming, which can lead to some, further re-rating.
Okay, further re-rating likely, there could be earnings upgrade, but let's now talk stocks, right? So with the Nifty at 18,000, what are the big themes to watch out for? That's the big question. You have titled it Digital Compounders, right? So just take us through the big themes and then we'll drill it down to specific stocks.
So as I said, I think one big theme we are seeing is this mobility, theme which we call, and this mobility is not just about we buying more vehicles, whether those are PVs or SUVs now. It's also about the fact that how this per capita increase in income is translating into more discretionary consumption. There is some pent-up demand as well. So now we are seeing a few long-term trends in mobility. One is the premiumization. So you want to buy more SUVs now. The mix is changing, and it's reflecting the changing lifestyle there. So you want to, we want to capture the entire ecosystem, which is a movement towards SUVs in the overall mix, within SUVs over electric vehicles as things pan out, and the guys who will provide that ecosystem, the component makers and all. So I think there is probably there are a lot of companies which can really disproportionately grow their market share, and that's where probably the delta will come from. So that mobility is our theme. The second is home improvement, which I was talking about. I think we want bigger spaces. Our 9-year house registrations in India current registrations are 9-year high. Mumbai was an all-time high last month in terms of house registrations. So we are buying more homes. We are, probably
bigger homes,
better homes, translating into this home improvement theme. Third is manufacturing. I think a lot of Indian companies increasing their footprint in electronics, APIs, chemicals, defense, courtesy what is happening globally. I think everybody wants to be more, self-dependent. And the last one, which has always been my favorite, is growing equity culture and the financialization of savings.
Okay, so all these are the themes, right? Just for the benefit of our viewers, there are 5 big themes that Gurmeet is focusing on. There's mobility, there's the manufacturing theme, there's defense. Of course, we've seen huge wealth creation there already. There's home improvement and financialization of savings. I think this has been a theme since the pandemic that you've spoken about, and it has done very well. Let's start with the first theme, mobility, right? You spoke about how everyone's looking to buy SUVs. the stock that comes to my mind is M&M. I mean, they have a swanky new SUV in the electric vehicle space, the XUV 400. In fact, we have images of that right behind, and it looks pretty. But these are stocks that have already rallied quite a bit. So do you think it's a bit late in the game, or is there still more to go?
See, some of the gains obviously are front-loaded. Whenever you're coming out of a 5-year cycle when auto hasn't done well, right? So look at Maruti, Bajaj, M&M. If you see the 5-year returns, they are still probably will be single-digit, right? So I think since you spoke about XUV 400, the stock price of M&M are also been, so they launched the model with fun, fast, and fearless. I think that's how the stock has been, right? Very fast and fearless, in the way it has approached. So I think
lots of fun for people who could capitalize on it.
Absolutely, and still at about 18 times FY24 earnings. So while we get carried away from 800 to the movement towards 1500, it's still 18 times, about 8 times EV by EBITDA, so reasonably valued. I think there are 4 trends in M&M. One is this, back-to-back successful launches. I think they've done a great job with Thar, with XUV 700, now Scorpio N. Second is the ramp up in production. So from 25,000 units, I think they'll get to about 35,000 with Scorpio N adding another 5, 6, and they're ramping up. Third is their clear market leadership coming in this SUV segment. They've captured the trend well, and now by FY25, they want to be the leader there. And fourth is, re-rating due to the EV. Currently, it's not in the price, but the XUV 400, they want to target the C segment. So Nexon is B segment, and XUV 400 is the C segment, where it's a slightly better range, better features, etc. And I think the tractor segment, which is again the bread and butter, second half should be much better. I think
they in fact said that the B and C SUV segment combined has a market of almost 98,000 per month.
Absolutely.
And they're looking to sort of capitalize on that market.
Absolutely.
But when you buy an M&M car, right, obviously there's someone making the tires, there's someone making the wires. So in the auto ancillary space, anything that makes sense to you?
Yeah, it's an all-time favorite, which is Uno Minda now, was Minda Industries earlier. I think what I'm impressed is the way they have increased the kit value per car, clear focus on premiumization. If you see their order book, 53% is now EV. So they're EV ready, plus they have a portfolio which is EV agnostic, so which is alloy wheels, car seats. If airbags tomorrow become compulsory, like 6 airbags, they have 15% market share there. So their bread and butter business, which is switches, castings, lightings, continues to do well, and they add premium products. So airbag, for example, the margin is 25%.
Wow.
One airbag is like $5,500. So if they can clock 11,000-12,000 crore sale with a bit of improvement in operating margin, I mean, the EBITDA can actually become 2x over the next 2 years. So there's still juice there, despite the stock being probably 15 bagger in the last 5-6 years.
Absolutely. Okay, that's the first theme, right? Mobility, in case you missed it. There's M&M and there's Uno Minda that Gurmeet likes. Let's move on to the second theme now, which is manufacturing. And this China plus one. Now, this has been a theme that has worked for a while. From here on, what are the stocks you're looking at?
So I think there are plenty, but in the interest of time, we'll discover, few. So one obviously is India's play on consumer electronics. I think Dixon is one name which comes to mind, which India's, dominance coming in consumer electronics. I think the mobile segment, in my view, can still deliver 40-45% CAGR, Sonia, over the next 3 years, which can translate into, huge volumes. They're adding more labels, more names. Secondly, the consumer durable was a little soft, but I think that will come back as we progress. Also, his product mix is changing. So from ODM, which is from OEM, which is original equipment manufacturing, where you only make as per specifications, right? So the margin is low. But in an original design manufacturing, it's your finished product, and then somebody takes the label, right? So that mix is changing. So he does both OEM and ODM. And I think that this EMS, which we call electronic manufacturing industry services, it's a $24 billion industry. Dixon is still 4%. Wow. So that's why it commands that 40-50 multiple, because the market, gives you that. So I think it's a great play on how this, manufacturing of electronic footprint India is becoming. 5 PLI approvals already, so that's adding to the kitty. And good balance sheet. ROC has been around 24-25%.
Okay, this is a well-discovered stock, right? Anything else that perhaps the street should know in this space?
So one slightly, value play is Tata Chemicals. I think it's not got re-rated like the others in this space, which is a PI or a Deepak Nitrite and Aarti and some of the others, still at about 15-16 times earning. Okay. But now, so it's 75% is base chemicals, which is your soda ash. It's the third largest globally on soda ash, sodium bicarbonate, etc. So this is basic chemistry. So this is 75%. 25% is specialty chemicals, right? So specialty chemicals, they are into, agrochemicals, which is through Relis, etc. And then they are getting into the new age chemicals. Soda ash, the prices might remain firm for next 2 years because there's no greenfield expansion coming for next 2 years.
Okay.
So that could be a big play there. And the mix is changing more towards specialty chemicals there. And they're trying to go more downstream, figure out more values. Also on new, EV-related, battery-related parts. A lot of plans there. And as I said, just 15 times earnings.
A lot of value-added products.
Absolutely.
Thanks for staying with us on Smart Money. We're having a very interesting discussion on all the big themes that you need to invest in as we head into the next leg of this bull run with the Nifty at 18,000 this week. Gurmeet Chadha has been with us and he has spoken about many themes. We discussed the first two themes, which is mobility as well as the manufacturing theme, and they'll come up for you on your screen in just a bit. Within that, in case you missed out on the stocks, M&M, Uno Minda are the companies that he discussed. There's also Dixon Tech as well as Tata Chemicals. But let's move to the next hot theme, which is defense, right? Out of nowhere, this theme has come back into action. But there are many of these companies, Gurmeet, that have issues, whether it's promoters selling stake, whether it's balance sheet problems. So just sift the wheat from the chaff for us, which are the companies to look at?
So you're right, there's a lot of PSU-dominated themes, and defense orders take 7-8 years to execute. So sometimes we get carried away by the order book, but the cash flow can happen over, there's a milestone payment. So you have to look at the continuity in order book and not just one particular order, because that impact probably will come 5 years, 6 years down the line. So one thing which I have been liking and being lucky in terms of getting early is solar industries. It started off as an industrial explosives player, then got into explosive initiating systems. So their base business is doing very well with demand picking up from exports. There's a power shortage. Coal India is their largest client. So that's drawing more explosives to mine more coal. Then infrastructure is again the end-use segment for explosives. I think where they've started doing well is the defense segment. So their defense order book is already crossed, good milestone. They are supplying hand grenades now. The Pinaka missiles are now on the final stage of testing, so that's done. They've also just submitted a 30 ammunition to Indian Navy. They've got into drones. They are working with ISRO on a satellite propellant. So it's a complete new segment they are getting, and there's great guidance on the order book. So defense can probably add 500-600 crore to the top line.
I think you've been bullish on solar industries for now 3-4 years. And it's been what, a 2-3 bagger already or more?
Oh, so it's more than, so last 4 years probably will be a 5 bagger. Since inception in 16 years would be, I think, 75-80 bagger.
Wow.
So very undiscovered, very little. Yeah. Because what happens is a lot of the business they get in a subsidiary called economic explosives. So people don't know that it's a subsidiary for solar. So defense again is happening on economic explosives. So people are tend to, and little below the radar. FIs have just started, institutional buying has just started probably in 2-3
Any
years.
red flags here? Because the stock has rallied quite a bit.
So expensive, and in between there were, the ownership dispute with the senior and the young, but that's behind, that's way back. So it's completely sorted. There's a second generation which is driving it, and very, very hardworking. And because we meet them very regularly in our cyber, they have come up with a weapon assessment range where you test weapons, right? Wow. So very high entry barrier. Who will make a weapon or a hand grenade these days if you are a startup, right? You don't want to go, it's a tough job. So very high entry barrier as well.
Okay, that's good, right? I mean, investing in companies that have high entry barriers. Any other stocks in this space?
So we track HAL, we track Bharat Electronics. There are a few there, HAL in particular. But solar remains the top.
That's your top pick in defense. Okay, the next theme, home improvement. This as well is a space that you've liked for a very long time. There are so many ancillary spaces, right? We start with real estate, then there are consumer durables, there's home improvement, there's paint, cement, and you track all of them. Yep. What are the top picks here?
So there are 42 sectors linked to home improvement, right? So it's in itself is a theme, right? So since in interest of time, we cover Polycap. That's again been an old favorite for some time. I think why I like them is the fact that they're moving towards B2C from B2B. There's premiumization happening. So in cables and wires, they are 24% on market share, and that segment is still 50% unorganized. So the base business will continue to do well. They've guided for 20,000 crores top line now. They're currently at 12,000 crores. So there is a roadmap till FY 25-26 clearly for 25% top line growth. Their fast moving electrical goods segment is now registering 40% CAGR for last 5 years, which is fans, heaters, lighting, etc. So both segments coming together 29 times. Some of the stocks are much more expensive, Havells, etc. So I think that's a very good balance sheet, good return ratios as well.
I've noticed that you pick stocks that are extremely expensive. I mean, I understand that many of these are market leaders and they're doing well, but are there any stocks which look good even from a valuation perspective?
Yeah, so as I said, M&M is not expensive. It's at 17 times. I think Polycab relatively in the sector is the least expensive. Okay. Your Havells, etc. Others are like 40, 50. Voltas is very expensive. Paints are like 60, 70 Ps.
For some reason, Voltas has not done that well.
Yeah.
Any reason for that?
See, I think their institutional business, which is their engineering, is something which has been very erratic in terms of, and then been affecting their working capital. Then there was COVID disruption. There was working capital issues. On the RAC segment, the AC segment, there seems to be now gaining market share. They're almost 26% now. So if they can get this working capital and improve return ratios a bit, I think should.
Okay, so that's the fourth theme. Folks, Polycab in the home improvement space. The last and final theme is financialization of savings. And within that, your top picks have been?
So CDSL has been an all-time, favorite. I think we've discussed it multiple times in various interactions. CAMS is another, related thing. So it's the RTA, which is the bookkeeper for mutual funds in simple language. 70% market share, duopoly structure, and top 4 out of 5 AMCs deal with CAMS. And now even the PMS AIF segment have started using CAMS. So there is a 50% share, and more PMSs and AIFs getting launched. They're also now very gung-ho on this aggregator thing, which is what lenders and financial planners will use. So what UPI has done to credit and payments, something can happen if there's a regulatory push there. Insurance repository was soft. With now this e-policies getting issued, probably that will get a leg up. And they are in this payment. So it's like a fintech play. Annuity model, you charge on the AUMs, and the AUMs for mutual fund industry are now growing at 15% for last 12, 13 years. I've been tracking this industry.
Okay.
So very secular play. Yeah.
All right. And no red flags here for both these?
No, not really. I mean, it's been in a consolidation. It's corrected a bit, almost like 25-30% from its peak. Still a little premium to listed AMCs, but that's the reason because it's a duopoly structure, sticky businesses, and it's gaining market share over Carvi. So there are only 2 players in this segment.
All right. Well, we have to thank Gurmeet. We could have gone on and on. His, wisdom is endless. And of course, we'll have to get him on another day. But these are the 5 big themes that you need to look at if you want to capitalize or if you want to sort of grow your corpus. Now, since we're talking about 5 themes, we've also decided to give you some financial tips. Let me thank Gurmeet for joining us. Gurmeet, thank you so much.
Pleasure.
And, on Smart Money, we've decided to give you some tips to get healthy financially, right? So every week, we're going to give you one tip. And the tip for today is why you should invest in index funds. 5 reasons for that. Now, index funds, as we all know, benchmark the index. So it helps you with a well-diversified portfolio. It follows the benchmark index and invests in companies that make up the index. So that's one of the reasons, a well-diversified portfolio. The second reason is safety. It's one of the most secure equity funds because the portfolio consists of quality large and mid-cap index stocks. It's less susceptible to market fluctuations as well. The third reason to invest in index funds is a low fees. Now, passive or index funds charge a fees of around 0.2% versus 1% fees that you would pay if you're investing in an active fund. The fourth, and I think the most important, is no fund manager bias. If you invest in an index fund, you're free from any fund manager biases. There's no chance of a fund manager picking up underperforming stocks. And the fifth and important part of investing in an index fund is steady returns. Now, on an average, the returns in an index fund has been in a range of 13 to 15% in the last 3 years. Now, I saw Gurmeet nodding aggressively, so I want to get a final view from you, Gurmeet, on it. Do you think for an investor who perhaps can't do research, right, index funds is the way to go?
Oh, absolutely. It's not about this versus that. I think index should be part of the portfolio. 70% of the funds have found it difficult to beat the index, which is what, so as market becomes more efficient, it becomes increasingly difficult to beat the index. Also, as you rightly said, there is no emotion involved in selecting stocks. So whatever is in the index, and sometimes one part of the portfolio should be emotion-free, free of biases. So that helps, and obviously more cost efficient. And index funds, they keep doubling every 5-6 years because if you see last 40 years return of Sensex, for example, yes, it just doubles every 5.5-6 years. So very, very smooth, no frill. No serious
Sleep
tracking
peacefully at night kind of investment.
So again, and a large cap bit, some part should go to index funds.
Okay, well folks, that is your financial health tip of the week. And with that, it's a wrap on this edition of Smart Money. Thanks a lot for watching.